First of all, again, your reaction again to what's happened overnight, this coordinated central bank action to alleviate the dollar. Could it be a liquidity crunch?
Well, I think the immediate reaction of the markets is that this is a stabilization on a macro scale, helping out some of the European banks on the liquidity side is certainly helpful for sentiment. On a technical level, what it does is it eases the concerns about dollar funding in the markets, and as a consequence of that, some of the forward points are going up in the Asian currencies. And so from that perspective, it kind of pushes back on the back burner the whole concern about is there enough dollars, particularly for European banks, and are they scrambling for funding. That had placed some pressure on the Asian crosses.
But overall, do you think it's going to work? Is it going to be effective? Is it enough?
Well, at the end of the day, it all comes down to Greece. It all comes down to the whole issue of peripheral Europe and what the debt dynamics are there. So this is, again, yet another stopgap measure. I mean, the central banks are doing ultimately what they are there for. They're meant to be a lender of last resort and a liquidity provider. But again, the underlying issue is the question of solvency amongst the European sovereign countries and the periphery, and that yet has not been resolved. All we've had are political assurances. We have yet to see a full follow-through of all the measures and so forth. So the question is still open.
Claudio, for many years I was interviewing in London about the euro, etc. again, and of course foreign exchange. And I know you moved to Asia right now, but let's just final question about this. What are the forex markets, in your judgment as well, telling you about the future for Greece, the future for the euro?
Well, I think it's rather pessimistic. I think they're somewhat discounting a default. I mean, that's the dilemma. I mean, it's already in the price. So the issue is, if we do get a default, how does the market react to that? And, there's some people in the market that say that the euro could actually rally. We get the bad news completely out of the way. We face up to the facts and we clear up the house and clean up the shop. But I do think what the market is telling you at this moment is the strength in the dollar is suggesting that no, actually, euro-dollar could break down further. And at the end of the day, when you look at the relative policy of merits, the US still has one degree of policy freedom, given it has a unified fiscal policy. So I do think actually we're still probably going to see much more stress in the system, despite some of the measures that have taken place, and despite the market pretty much pricing in for the worst. I think, and from this perspective, from this part of the world, I think we still have to watch China very closely, because that's the thing that hasn't been entirely factored in. And thankfully, so far, the China data has been quite positive. But in the rest of the region, we've seen deterioration in the growth numbers, and that's where we have to be careful.
So on that point, how worried are you about the implications for China?
Well, I think at this stage of the game, I think what we've seen in terms of the market, we've obviously got dollar China around the 638 level, the forwards pricing in 635 by the end of the year. We're looking at 630. So the market has already started to pull back its expectation of appreciation. The issue here is about the inflation. We had the 6.2% inflation headline print, which seems to suggest that we may have peaked in inflation. And this is absolutely critical, actually. The fact that the data could get worse in China, fair enough. But the issue is, has China got room to maneuver? And that is very important in terms of headline inflation pushing lower. If you have headline inflation pushing lower, then again, China can move in terms of fiscal and monetary policy. And so I think we still have a cushion in Asia, which is very important in that regard. And we've already started to see Asian central banks turn more dovish. Today is obviously a very critical day with the Reserve Bank of India meeting, the whole market expecting them to hike, but there is a risk that they could hold, and that would be yet again another signal that some of the key economies in Asia are actually, and policymakers are actually hedging their bets. So I think we have the one saving grace in Asia is that we have monetary policy, fiscal policy, we have latitude to try and soften the blow.
In your research, Claudia, about the Indian story again, the rates today, of course, you say that there's several months of big upside surprises to inflation is the risk. Big upside. I mean, is that a big issue? Is that clearly about food inflation?
Well, yeah, clearly food inflation to a certain degree. I think, again, what has happened is obviously oil prices coming off. We had an announcement, for instance, out of India that they would raise the gasoline prices. We estimate that that should increase inflation by about 15 basis points. Obviously, the Wednesday WP number, wholesale price inflation number for India was above expectation, and so that continues to be an issue. And that's the dilemma, actually, for a lot of the countries, is if the world does face a slowdown and the West continues to push this monetary easing policy, it does lend to distortions into the asset markets, into the commodity prices. So that's where the risks lie, and that's where the dilemma lies. But I think for the moment, what we're seeing in the oil prices is certainly helpful going forward, and I think that will help. But unfortunately, when you look, sorry to focus entirely on the Indian rupee, but when you've looked over the past 5 years about what matters more for the Indian rupee, growth or inflation, actually growth matters more, partly because of the current account and the dependency on capital flows, which are highly pro-cyclical. So I think really the upside risks are to dollar INR heading higher here, even if the inflation were to come off, and even if partly because of the downside growth risks. And we saw the disappointing industrial production numbers.
Final question for you, if I can, Claudio. The Indonesian rupiah, of course, intervention of recent, the best performer amongst the 10 most active currencies in Asia, excluding Japan, since the end of 2008. Again, can that continue? What do you believe, do you think, what are you hearing from your desk, is the best currency trade right now?
Well, what we've recommended, I mean, we've certainly warned about, concerned about the weakness in the IDR, but we don't think it's protracted. We don't think it will be the beginning of a sustained weakness. Largely from the flow side, we don't see redemptions by the bond, the real money accounts. We think it may be related more to short-term holdings of SBI, short-term paper in Indonesia, related to maybe some foreign banks onshore unwinding their holdings and repatriating those holdings, and that squeezed dollar IDR higher. What we are recommending actually is to be short Taiwan dollar, short Singapore dollar against US dollars, just in a basic forward format or basket. And again, those are two very pro-cyclical open economies. The second trade that we're recommending is actually a worst off option. Basically, we're bearish on the Korean won, the Malaysian ringgit, and the Taiwan dollar, and you'll basically get the you'll basically benefit from the currency that depreciates the least from that, but it's a cheaper hedging cost on that. And finally, just to say on the interest rate front, we've got steepness 2s5s in Malaysia on the interest rate swap market.
Claudio, great to see you again. It's been a long time. Thanks for
you.
joining us there from Singapore.